Hi there, welcome back to Summer Money. We're picking Woolworths because it's just something that we can compare Qantas to, because a lot of people are familiar with it.
Yeah, and everyone knows Woolworths, and I don't have to...
Yeah, easy
it's going to cut into our time on the show if I have to explain what the company does.
Don't want that. All right, let's get to it then.
All right, so have a look at this business. So starting back in 2000 again, and having a look at the profit back in 2000, you can see that profit was $295 million or thereabouts. And the profits increased almost tenfold. It's increased to $2 billion in the current year. And so what we've got is a change, an increase of $1.8 billion. That's pretty good. But equity's been contributed to this business as well. Remember, with the Qantas example, if we were running Qantas, we had to contribute an additional $3 billion on top of the $3 billion that we'd put in at the start. Well, some additional money's been put in here. You started the business off in 2000, hypothetically, with $1.6 billion. You've added another $6.2 billion, so now you've contributed $7.8. Now, you might immediately think, well, that's no good. I've had to contribute lots of money. By the way, let me just say this. I would rather a business where the profit went from $295 million to $2 billion and I didn't have to put in a cent. I didn't have to put in an additional dollar. That would be the perfect business. This is still pretty good, because have a look at the return on equity that the business is achieving on the additional money that's being put in. Previously, it was earning 18%. It's now earning almost 26% on the total capital that's been contributed by the shareholders.
And that's purely because it's a better run business.
It's a better run business. It's a business that is being well managed. It's got monopoly characteristics. It generates cash from its working capital. It's got a whole bunch of advantages. Now, you'll also know that the debt's increased as well, and you can see that down the bottom. I would prefer not to see that debt increase. However, even though the debt's increased, the company generates a lot of cash, so it's able to pay that debt fairly easily. So this looks like it's a pretty good business. And in fact, the return on the additional money that's been put in is equivalent to about 29%, 27 or 29%. So the return on equity is going up. If we go to the next slide, you can see what that looks like graphically.
Yeah.
So we'll do that now, and you'll see, similarly to what we had with Qantas, but you can see it looks very different. Yes, the equity has gone up a lot. Yes, the debt has gone up, but the profit has gone up a lot. In fact, on a ratio basis, the profit's gone up more, and the result is that the return on equity, that horizontal line that's going across and rising in a northeasterly direction, has gone up from about 18% to about 26 or 27%. And that's telling us that injecting that additional money into the company has been a profitable thing to do. First slide gives us the ingredients that we need. So what we're interested in is we're interested in the shares on issue and the shareholders' equity. Now, the shareholders' equity comes from the balance sheet. That's at the bottom of the balance sheet. It's the assets minus the liabilities. And we want to divide that number. We're going to divide that number in a minute by the shares on issue. And the reason we're going to do that is we want to work out how much equity does every share have. We're going to buy a share. We're not going to buy all of Woolies. We're going to buy one share, and we want to know what each share is worth. I need to know the return on equity. I want to know how profitable that equity is. And this is the number that's really important. Mae West famously said, too much of a good thing is wonderful. So what we want is a really high number there that we think is going to be sustained in the future. And I think Woolies has been able to achieve a very high rate of return on equity for some time. Then the other piece of information that I want is the earnings per share and the dividend per share, because what I'm going to do is from that information I'm going to work out what's the payout ratio. How much of the profits are paid out to me as a dividend, which I'm going to spend or I'm going to stick in a bank account at a low rate of return, and how much of it is retained by the company and generate another 26% next year. So that's what I'm interested in. And then the other thing, the last thing that I want is the required return. What's the return I'm expecting for investing in this company?
So
what
this
return
is a number
do I want
that you're setting for yourself?
For investing in this business, yeah. So if the business performs as I expect, after tax, what return should it give me based on business performance? And Warren Buffett has talked about using 10%. I think you should use different numbers, but we're going to use 10% for this example. So let's shoot straight to the next slide. Okay, so if we divide the shareholders' equity by the shares on issue, we get $6.15, and that $6.15 is the equity per share. If we divide the dividends per share by the earnings per share, we get 70%. So 70% of the earnings are paid out as a dividend, and the next is the return on equity, which is the earnings per share divided by the equity per share. We've already established that's 26%, so we'll hang on to that. We're going to use that number. And then the final one is 10%, which is what we've already talked about. So if we go to the next slide, and it's coming up, All right, so what we do is we divide the valuation process into two parts. The first part is the income part. We're going to divide up that part of the share that's paid out, the part of the performance of the company that's paid out to us as a dividend. And what I've done here is I've lined up our 10% return that we're looking for with the I'm going to use 25% to be a bit conservative, with a 25% return on equity. And this table comes from my book, so it's straight out of the book, and that lines up, that gives us 2.5. That's the first multiplier we're going to use. We're going to multiply the equity per share by that number. So that's the first part. And if we go to the next slide, I've done exactly the same thing again. And here what I've done is I've lined up 10% and 25%, but it gives me a different multiplier, 5.2. And that's the growth part. That's the part where the company retains the profits and keeps getting 25% on its money. And I want to know what that part's worth. So if we go to the next slide, you'll see how this works. I'm just going to multiply those two numbers, which are in the boxes, by the $6.14 equity per share. So in step one, you can see if I multiply $6.14 of equity per share by my 2.5 multiplier from the first table from my book, you'll get $15.35. And what that means is that's the value, that's my estimate of the intrinsic value of Woolworths per share if it paid all of its earnings out as a dividend.
Okay.
The second step, $6.14 times the second multiplier, 5.2, gives me $31.95. That's what Woolies would be worth to me. That's what I'd be willing, that's what I think it's worth if it paid no dividends at all and it retained all its profits and kept getting 25%. Now what we know is that neither of those things are true.
Right.
Neither of them are true. It doesn't pay all the earnings out as a dividend, and it doesn't retain all the profits either. It does something in between. And you might remember it pays out 70%. So what we're going to do is we're going to multiply that $15.35 by 70%, which is on the next slide, and we're going to multiply the second number by 30%, which is the amount of the profit that's retained, and that gives us the second number. So $10.74 is the result of the first calculation, and $9.59 is the result of the second calculation. We add those two numbers together, which is coming up on the next slide. If we add those two together, $10.74 plus $9.59 gives us an intrinsic value for 2010 of $20.34.
Okay.
So based on those numbers that I've just gone through and those estimates of the future, assuming the payout ratio stays at 70% and assuming the return on equity is at 25% and that continues, then Woolworths is worth $20.34 a share for 2010. And what I've done there, you'll notice, is I've also put in my estimate of its value for 2011 using those numbers. And what we want to see is we want to buy businesses whose intrinsic value is going up at a good rate of knots each year as well. Because if Benjamin Graham is right, and it looks like from that chart of Qantas he is right, over long periods of time price follows intrinsic value, then we want intrinsic value to be rising, because then the price ultimately will go up. It'll go up and down in the interim, you know, sometimes it'll go down and up in the short term, but long term it'll follow intrinsic value. So we want to buy businesses whose intrinsic value is rising. Now Woolworths today is more expensive than those numbers, so at the moment it's not cheap. It's not a bargain. It's not representing great value. Right.
Doesn't mean that it's a bad business. Just means that it might be not one that you want to buy now.
There's two pieces of the puzzle. A great business at a cheap price. If we get those two things together, and during the year this year I've talked about companies like Matrix Composite and Engineering. I've talked about Forge and Macmillan Shakespeare and a variety of different businesses when they met those criteria. And thankfully they've all done really well.
And Woolies, do you own Woolies?
No, I don't. No, because it's not particularly cheap at the moment.
Right. So when we take these formulas and everything, it's been fascinating, but you know, it's sort of hard to keep up sometimes. So where are we getting all these formulas from?
Well, look, thank you for that. Well, the two tables come from my book, so I've really simplified it in the book. What I've tried to do is get away from formulae and having people make mistakes in their calculations. So instead, what I've done is I've said, look, here's some simple tables. Just multiply the equity by this number and you'll get the result. Multiply the equity by that number, add them together, and away you go. And it's a really simple way. And I'm really grateful that so many people have taken a shine to it and they've used it and they've been really successful with it this year. And it's been, admittedly, there's been a rising tide, the market's gone up, but many people who've read the book and used those tables have found that they've outperformed the market.
This is Sky News Business, Australia's business channel.